Trading can be exciting. It can also be risky. To succeed, you need a trading plan. This plan is like a roadmap. It helps you make good decisions, even when things are moving fast. Your emotions are important in trading. Fear and greed can make you lose money. A good plan helps you control your emotions. Before you trade with real money, practice. Use a demo account. This helps you understand the markets and test your plan. To trade well, you need to understand the economy. Economic reports tell us how strong a country is. These reports can affect the prices of stocks and currencies. The ISM Manufacturing Index tells us about factory activity. High numbers are good for the economy. The Gross Domestic Product, or GDP, measures a country's total economic output. A growing GDP is a positive sign. These reports are released regularly. Traders use them to understand the bigger picture. They can help you spot potential trading opportunities. Markets move in cycles. They go up, they go down, and they move sideways. Understanding these cycles helps you find trading ideas. When the economy is strong, stocks tend to go up. This is a bull market. When the economy is weak, stocks tend to go down. This is a bear market. By following economic reports and market trends, you can find potential trades. Remember, trading is about probability, not certainty. Section 4. Building your watch list. Focus your energy. Don't try to watch every market. Choose a few markets that you understand. This is your watch list. Your watch list could include stocks, currencies, or commodities. Focus on markets that fit your trading style and risk tolerance. A balanced watch list has a mix of different assets. This helps to spread your risk. Review and adjust your watch list regularly. Section 5. Timing the market. Technical analysis for entries and exits. Technical analysis uses charts to study price movements. This helps you to time your entries and exits. Support and resistance are key levels on a chart. Support is where the price tends to stop falling. Resistance is where the price tends to stop rising. Moving averages are lines on a chart that show the average price over time. They help you identify trends. Traders use many other indicators, such as MACD and RSI, to confirm their trading decisions. Section 6. The art of execution, making the trade. Once you see a trade, you need to execute it. This means placing your orders. There are two main types of orders: market orders and limit orders. A market order buys or sells at the current market price. A limit order buys or sells at a specific price or better. Always manage your risk. Use stop-loss orders. A stop-loss order automatically sells your position if the price drops to a certain level. This limits your potential losses. Section 7. Conclusion: the trading plan, your roadmap to success. Trading requires knowledge, discipline, and emotional control. A trading plan helps you stay focused and consistent. Your trading plan should include your trading goals, risk tolerance, preferred markets, and your strategy for finding and executing trades. Review and adjust your plan as needed. Remember, trading is a journey of continuous learning and improvement. Stay informed, be patient, and never stop learning. Don't forget to like and subscribe to IBF.